You will have disproportionate gains in short time frames, but you've got to count in years. You've got to count in years for those. If we're talking about 108,000 gold and 14,250 on silver, it's not next week. It's not next month, obviously, but you'll be shocked at how much things will change and how, look at how much we were at below 1,000. We'd never made the 1923 high. That was 2011. Then we were stuck at 2,000 for an extended period. Now you're on the door of 4,000.
After breaking out from a 4-month consolidation period in early September, the price of gold has continued to trend strongly higher in recent weeks. On Tuesday, commodity analysts at BMO Capital Markets published their fourth quarter price forecasts, making significant upward revisions to gold and silver. The U.S. government is once again on the cusp of a shutdown, bringing renewed focus to the nation's burgeoning debt. A Canadian bank believes this will be the latest driving force for gold through the end of the year. Veteran analyst FrancisHunt envisions a moonshot near $108,000, arguing gold's true bull market began in 1913, with the Federal Reserve marking the start of fiat debasement. FrancisHunt just applied a ruthless piece of technical Fibonacci analysis to gold's massive, multi-decade move. His target is not a few $1,000s higher. He cautions that such levels may trigger a sharp correction and bubble talk, but insists this would be a natural phase of the bull market. Hunt believes gold still has the potential to climb more than sevenfold from current prices, noting that later waves often move faster and with greater volatility. According to Francis, that was the point where systematic debt creation and fiat debasement truly began. Before the Fed's establishment, he notes, gold held a stable purchasing power for decades during which the dollar's value remained effectively constant. From 1913 onward, however, debt-driven inflation, world wars, and financialization reshaped the system entirely. The greenback is enduring a bruising 2025, down more than 9% so far this year, amid concerns about Fed independence and those trade war concerns. That mechanistically lifts the value of gold in dollar terms. Before we dive into FrancisHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
We're going from here, the low. In fact, it's there. It's slightly lower there. We're going from here in 99 July. This is how you do a Fibonacci extension. You grab that low. You take it to the high, that is $1923. So you're going from $252. Brown's bottom. We all know about Brown's bottom, how he sold it on the cheap, knowing the inflation was coming, pretended to be stupid and say, well, we need the money, and sold out Britain's gold to a different name on the clipboard. Yep, we can only guess as to whose name that was. And we run this up to here and we go, okay, we want 1.618. We want a number that represents 1.618. That means it is 61.8% longer and further than the bottom of the bear market on this new 5-leg upswing, which happens to go 61% further. So with drawing that, you will see that I've captured the low there, round about 1,045, maybe a bit closer. Let's run it a bit closer. It was 1,045, I believe. Want to get it as close as possible. It's kind of hard. Okay, we'll put it there on the magnet. That is accurate, 1,046. Where is the 1.618? That number right there, 27,988 for gold. Your CD leg can take you to 27,988, to the doorstep of 28,000. At this time where I'm actually expecting a little bit of a sell-off, I'm telling you about the future to keep your spirits high, because everyone's going to get bearish and say bubble pop, it's all over. We'll get the price 3,819 at the moment, 27,988. Now, if you were to get there in short succession or in long succession, as I'd more likely expect it to be, you are going to do a multiple of 3,818. In fact, we do it the other way around. We're going 28,000. It's almost 28,000. These are not to be exact to the pence. The 161.8 should be met or slightly surpassed. 28,000. Divide where we are now, let's say you'll be able to buy at 3,800, 7 times, 7.36 times where you are right now, which in percentage terms is 830, it's 636%. You'll make 636%. Almost did it the wrong way around. 636% from here. The other interesting thing about time and duration is as you get deeper into the 5 waves, typically these get faster. That's not the 5 wave we want. The first, the pullback. What tends to happen, the gradient gets steeper than the previous leg, and we are going up to here. So it can often happen in shorter time frame than the first leg's gradient, which could see you making it somewhere there. Then you have a pullback. It can be more volatile, so it can be sharper on the downside. And then you have your 5th leg going in. And we are talking right now about the D, the delta point CD, the 1.618, and it is 27,988 for gold. Right, let's take you to the crazy number, which is very moon boy of me, the 108,000. And what's associated with that? What could be associated with that? So I'm going to give you the same framing for one possibility. We've taken in this example the fact that that was a contained bull followed by a subsequent bear market, and this is a completely new, fresh, and beginning new bull market. What I'm going to say to you is, what if the real framing, the real macro framing for gold and precious metals is not about something that started in 2000? And for this, I will go back to the Oanda chart with the real history and switch the eyes off and take that Fibo off. What if the real commencement for all of this was the creation of the fractional reserve banking, which was the beginning of debt, over expenditure, debasement of fiat, and the inflation creation? The creation of inflation is governments that overspend. Simple as that. Because they are issuing more money by creating additional debt instruments at an accelerated rate. So, prior to the establishment of the Federal Reserve, 1913, which takes you back somewhere here, you actually had quite a long period of flat gold prices. Flat gold prices means there certainly wasn't a great loss of buying power in your dollar. Gold got the same price. You got the same amount of groceries for that price, and everything was hunky-dory. You're talking from 1833 to 1913. That's over here. I've overdrawn my pink cube. Non-stop period of fixed gold prices. Now, I won't ever say certain things didn't go up. You'd have feasts, famines, droughts, and various other things. But I suspect they went up very slowly because the time the Fed needed to proliferate and create debt, hence why they kicked off 3 wars, 2 world wars and a brutal Georgian Bolshevik communistic implementation on the Orthodox Christian Russians, who were slaughtered en masse to the tune of somewhere between 20 and 60 million, the greatest genocide ever, followed by what went on in China when they introduced communism there. Those are the great world genocides, by the way, not other things that you might be deluded about. Nonetheless, if we take from 1913, let's find it, and say the beginning of debasement began here. You see that? It says 2012. What if the framing for gold is entirely different and it is all one big 5 wave? This is what financialization of everything does to your society. And let me just get it. There's 1911, 1905. Let's stretch it out. What if that's the framing? In short, your Elliott wave starts here in 1913. That is your AB leg. You have a 20-year pullback, which is your BC. And then you are advancing on a C and D leg, for which you are still in the CD leg phase that started in 2000, 2000. Where does the 161.8% take you, you might wonder? In one giant 5-leg Elliott wave from the commencement of the Federal Reserve in 1913 at a fixed price. By the way, the suppression, once you had a banking cartel, debt and borrowing during these years, is part and parcel for the subsequent overperformance here. Manipulated by decree. And the fact it ripped to the degree it did in these eras shows that was the case. Instead of having the gradual bull trend, it had a long flat period by decree, leading to a far more vertical trend. And guess what? That manipulation has actually been, in a sly way, around today along your silver and gold markets, and you're about to get the unleashing of being on the wrong side of that manipulation, the shorts, that will bring the same gifts, meaning this CD leg, let's label it for you. Here we go right back to the 1913, and we say A.
In 2025, markets will have gradually factored in Fed rate reductions, resulting in lower real yields and bolstering precious metals. That dynamic is a primary catalyst for silver's rally. The movement away from US dollar dominance has gained significant momentum, with over 100 countries now actively diversifying their reserves away from the USD. This shift represents more than just portfolio rebalancing. It signals a structural change in the global financial architecture. In his observation, FrancisHunt maps silver's wild upside using Fibonacci extension projecting almost $15,000. Paired with his gold call, that implies a single-digit gold-silver ratio near 7.6, an extreme yet possible outcome within his Elliott wave framework. The bottom line is that all it would take is for China or Saudi Arabia to call for delivery at futures contract expiry at even a small percentage of their holdings, and we could see headline news lead to a run on physical silver the likes of which have never been seen, or we will likely see again. Let's get back to the interview.
You have triggered on probably the biggest upside HVF with $330 target right there. And post that, if you take from the lows, the fixed lows, remember silver in these eras, you used to be able to buy things with cents, was 28 cents. At this point, it was 28 cents. What's the low? 28 cents in 1932, the bottom of the depression. Silver was 28 cents, friends. You're talking about today, $46.17. You've had a little bit of a push into the 47s and a rejection. This flagpole right here, projected here, gives you 596. The upside HVF that I will draw for you will give you the 330 that we've given you. If this is the one leg and the down leg, the 1.618 for silver is up at what goes for gold goes for silver. If this is all one big bull trend with a 20-year correction BC leg, for which this represents your C, let's write those letters in, A, B, and C. The 596 is a bull flag projection, but the 1.618 will give you $14,000 in silver. $14,000. It won't be the same dollar that you're used to. It'll feel like a cent. They probably will have cut some zeros off at that time, but that will be value retention. 14,249. So at 108,000 gold, you would probably have $14,250 silver. And that would still be quite a stretchy gold-silver ratio, by the way. One of them might underperform or overperform. Let's just do it. If both are treated on the same basis and do this. This is all spitballing, macro spitballing, real macro spitballing. It's fun. Don't take it excessively seriously. It's fun. But if you were at 108,000 and you were divided by 14.2 thousand, you would be at a 7.6. That is single digit gold silver ratio. which is part of our predictions. So both gold making its 1.618 at the same time as silver makes its 1.618, you will have fallen from 86 to 7.6 on the gold silver ratio. Interesting, single digit gold silver ratio on the 5 impulse, the 5 legs up, the 3 and 2 pullback legs, let me rather say, A, B, C, D, D, E, and EF leg for Elliott wave theory. There you go. Some of the biggest, most moon boy calls you can have in precious metals. 14,250 silver, 108,000 gold. Gold silver ratio 7.6 down from its current 86 or 75. What's it at? Let's give you an exact one. What's it at today? Gold silver ratio is currently, I think, low 80s. XAU, XAG, 82.7 at the moment, 82.7 on your gold silver ratio. I'll make a few other interesting points while we have the live stream on. There's 852 of you watching, by the way. Thank you. We'll also show you the Dixie and why I say it could just be about to end. We made those targets. Let's recap. HVF daily pattern made. Let's do all the charts for what we said. Okay, gold, XAU, USD. Daily gold chart, upside HVF. Let's get rid of our fibs. We've had our fun on the big time frames. Let's go down to the daily chart. Let's max this out. Okay, that right there was your target. This represents a degree of overperformance, and you're getting an interesting candle there that pointed. Maybe it's a bit of a rejection. Maybe we'll be right, maybe we're wrong, but it's a red candle. We haven't had too many. From here, 1, 2, 3, 4, 5, 6, 7, 8 green in a row with only 1 red, 2 red, 9, 10. Then we had this continuation pattern, which was 11, 12 green, but 2 red candles. So that's 4 red, 5, that's 13, 14, 15, 16 to our target greens with only about 8 red candles, most of them very, very small. The possibility now is that you'll face a little bit more headwinds. We'll show you the Dixie as to why. We made this target on the Dixie. On platinum,
Gold's run is a masterclass in sentiment. When geopolitical tensions, fiscal blowouts, and central bank support line up, old rules start to matter again. More recently, President Donald Trump's attempts to reorder America's relationships with its major trading partners have rattled governments, adding more fuel to the gold rally. If physical demand suddenly overwhelms paper markets, could gold and silver force a reset of the global financial system faster than anyone expects? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.